So as I said, this is part 2. Warren did a presentation for us last Monday. We've got 2 more, Tuesday. We've got 2 more for the next 2 Tuesdays in May at 10 o'clock. We do record them. I will send in the automatic system links to last week's video and to this week's video. Last week was very much a 101. This one very much more practical. We keep it short, but we've got time for questions. So if you've got the questions, drop them in the Q&A box. But with that, Warren, over to you.
Thanks, Simon. Morning, everyone. Okay, today we're going to start off with part 2 of the Forex system, and it's going to be about leverage. I'm not going to spend too much time on it. It's something that you can please go back and just take it slow, read the slides again. Leverage is the relationship between your capital and your exposure to the market. So it has nothing to do with an individual trade. It's all your accumulated trades put together. So as an example, we have an account size of $5,000. The position size is €1 contract, which equals 5,000 euros. And we then multiply that by the dollar exchange rate, and that will give us the exposure. So you take the prevailing exchange rate, multiply it by 5,000, and you get an exposure of $5,603. Obviously, as the price changes, so does that exposure value. And your account is now considered to be 11% leveraged. In other words, it's not leveraged. 100% would be a full position. So $5,000, if you had $10,000 in the market, you would then be double exposure. So you'd have 110% leverage, and you can probably push that to 3 times your capital. So you can go up to 300%. That's just a rule of thumb. What you would have to do is just calculate how much risk you can actually stomach. The greater the leverage, the greater the risk and reward. Obviously, I'm more interested in the risk portion. So the bigger the position size, the more risk you have if you're wrong, and you're going to be wrong often enough to make sure you take note of the risk numbers. So if we have a look at risk and reward, so we take one contract, remember that equals 5,000 euros, times the prevailing rate, and the market moves 100 pips in your favor. Now remember, there's 5 decimal places. The 4th one is a pip, the 5th one is a tick. I just work on the pips. And we have a 100 pip move. You take that one contract multiplied by the entry price, take the contract multiplied by the exit price, and you get a $50.50 different. So if you were right, you would have made $50, and if you were wrong, you would have lost 50. If you had taken 2 contracts, same thing applies, multiply by the entry price to get exposure, multiply by the exit price, and you would have made or lost $101 on exactly the same price move. So if you were correct, you would have made $50 based on one contract, or $101 based on 2 contracts. And then, of course, the important part is if you were wrong, you would be down $50 or $101. Okay, and that's for the exact same price move, and that's pretty much what leverage gives us. And you can calculate that back into your account balance. Gearing is simply the relationship between your margin and your exposure. So if we look at gearing, we take a US dollar 5,000 exposure. The minimum margin requirement in that particular pair is 2%. Which means your margin requirement is 100 euros, but you have a US dollar account, so you have to multiply by the prevailing price, and that will give you a margin requirement of $112 to get 5,000 euros exposure to the market. This is a variable margin rate and changes with the underlying price, but remains at 2% of 5,000 euros. And when you look at your deal ticket or your order entry, the impact figure on the deal ticket includes your in and out costs, so whatever your commission cost would be. In this example, your gearing is 50 times, so that means you can take 50 times your $5,000 account. That's not recommended, but it is possible. This particular formula has no real relevance to your trading because exposure is the important number. You make and lose money based on exposure, not based on margin requirements, and that goes for all trading. Okay, let's have a look at the real impact of gearing and leverage. The reason people really like Forex is the low margin requirements. So you can get huge numbers in exposure for very little deposit. So if you look at something like the ALSI, you require, I think it's somewhere in the region of 40,000 Rand now to trade the ALSI. For margin with the 400,000 exposure, your currency is a lot less than that. for 5,000 euros, for 5,000 pounds, I'll just change it to pounds here, you're going to make or lose $50. Your margin requirement is only $176 for 5,000 pounds exposure. Then for 10,000 pounds exposure, you're going to pay $333. Remember, that's including cost. And then for a bigger order, you've got 50,000 pounds, and you're going to pay $1,500 in margin requirement for that. And the 100 pip move, this is the difference between them. 100-point move would make or lose you $50 on 5,000, $100 on 10,000, or $500 on a 50,000 pound exposure. When calculating your preferred leverage or number of contracts, use the above figures, so these $50, $100, $500 points, and decide whether you can deal with that as a stop loss or not. In other words, if you're wrong, the market moves 100 points, which one of those is going to suit you the best? If you have large trading accounts, then you can take larger positions. If you have small trading accounts, you really should be trading smaller positions and not utilizing the full impact of that gearing. So yeah, please be aware of that. Currencies can get you into trouble. They can move really quickly. And on the next slide, I've got an example. It's just a 15-minute chart I took here to illustrate my point. And here's an example of a 100-point move after a short trade. So there's a short signal coming in there, and I just used the breakout. So once it broke below support, you go short. It's a valid trade, and the market goes immediately against you, and it does 100 points in 1.5 hours. So if you go back to these numbers, you figure out which one of those suits you the most in 1.5 hours worth of price movement. Now, obviously, 1.5 hours is not much when you're trading. You go into a meeting, you come back, 1.5 hours is gone, and you're down whatever your exposure was there. The rest of the move basically took 7 hours to move 200 pips, and if you took the day off and you were over leveraged, you would be in quite a bit of pain. And this is why I always recommend keep your positions to a reasonable size and small if possible as you're learning how to trade. As you get better at trading, you become a little bit more, or should I say, you become a little less risk averse, and you can start taking larger positions, but you really have to be good at it before you consider doing that. So use these numbers to get an idea of what overall effect your position size will have on your capital. It's really important, guys, to go back, look at these slides again, calculate what you're comfortable with, work out how many contracts you can trade on any of the pairs that you're interested in. Okay, today I'm going to share some technical strategy, and everything I share is what I use to make my trades. And we're going to start off just on the dailies, and I use the 21 and the 89 exponential moving averages to determine the trend. So if the 21's above, the 89 trend is up, 21 below, the 89 trend is down. On the currency side, I do buy or sell at the crossover on the daily charts for a long-term trend trade. The goal here is to have a position in the market for anything up to 12 months. And if you're really lucky, it'll last for 18 months and you can make quite a bit of money out of it. And when you're trading like that, you don't need to have large initial position sizes. And that's the beauty of having something that is in for the longer run. This is really important. A backtest is required to make sure that the pair you're watching has a history of successful moves on the system. So if you go and have a look, I think it's the pound euro, doesn't have a great result on the system. Don't trade it this way. Okay, so do have a look at your charts. The pound yen has worked pretty well on 21.89. The euro dollar has worked pretty well on 21.89. And you're welcome to go and have a look at the rest of them and make sure that they make money. Once we're in that trade, or even if you maybe have a shorter time frame in mind, you don't want to trade the daily, maybe your account's not big enough to do that, we can still use the daily for trend and then move into the lower time frames for the trading opportunities. So daily trend dictates the direction for my intraday time frames. The 4-hour chart is my next level down from a daily. The 21 crosses the 89 remains my main trigger in that time frame. So I'm still interested, 21.89. As that crosses down, if the daily trend is down, I want to enter the 4-hourly chart. As the price moves in my direction, I look for alternative entries apart from the initial trigger of the crossover. So once the crossover has happened, I can't be chasing that trade a day later and then expecting to catch the majority of the trend and wait for the averages to cross the other way. I'd have to look for some other reason to enter the trade. So we don't chase, but we wait for a proper signal in the direction of that initial trade. So the alternatives can be used to add into a winner or as entry after the moving averages have crossed. Quite important, adding to winners on a 4-hour chart is generally better after the initial daily crossover. So in the beginning, the daily chart will cross, then the 4-hour will probably already be in a trade. We're going to have a look at the pound dollar now. Then the 4-hour can pull back and cross the opposite direction, cross down again, and I can get my second entry. At the end of a trend, or in a mature trend like we have at the moment on dollar pairs and euro pairs, it becomes a lot more risky to trade the 4-hourly charts on the crossovers. Okay, so as that trend matures, I want to reduce my position sizes on the 4-hourly chart, just in case we're ready for a turn, and the charts will explain that much better. Here's just an example on the euro US dollar. The daily trend has been down since May 2014, and that's where the 21 crossed the 89 on the daily. On the 4-hourly chart, and that was December last year, we had a crossover and the entry was in that area. Short was taken, the market dropped, all great. When the price crossed and closed above a previous swing high, the trade was closed. So if you drew resistance lines, that would have been stop loss. That would have been stop loss, never really closed above it, I promise, if you put a crosshair on there. That one became the swing high. The market eventually closed above that swing high. You can exit the 4-hourly trade. And that can get you into these nice long trends. And the idea would be, I don't wait for the crossover to stop me out. I'd rather get out so I can get back in again sometime in the future. Bank the profit on the 4-hourly chart, wait for the next trade, which is depicted on this chart. And basically I just zoomed in. That's the same consolidation. The last trade was exited in that point. The EMAs never really crossed again. In other words, I didn't get a moving average crossover. It came close over there. But by the time that occurred, I already had a definitive consolidation. Okay, so the support level was created. That orange circle depicts the beginning of the consolidation. Extend the lines into the future, and we can see good support level. The averages came close to crossing, didn't quite cross, so waited a little bit. The support level is broken. The daily trend is still down. Enter the trade with swing high as a stop loss. The market moves lower and lower. You could have had a tiny little swing high there. Moves lower, and that swing high is broken on this huge green candle. So the orange square is the exit, and that was when it closed above that resistance level. All right, so the exit was quite high, and sometimes you have to take that knock. The idea that we can just exit over here or exit down here somewhere, we're not going to catch the full trend. If you had done that on the previous chart, you could have been out over there and no real opportunity to get back in, maybe over there. But the idea would be, if I can catch most of the trade, I'm a lot happier. And when I do get cases where it pulls back probably about halfway from the lows, I'm not too concerned. Overall, I just want to accumulate pips. Okay, the third and fourth trades, this is still the Euro US dollar. I'm still on the 4-hourly chart, and I'm just showing the 21.89 crossing over. The next two trades were straightforward EMA crossovers with a stop on a close above the previous high. So there the crossover occurs, the entry is at that level, and the stop loss is at that swing high. Okay, so that was a losing trade. Go short over there, stop out up here, and you wait for the next signal. Daily trend is still down. There's the next trade signal. So you go short around there. Market doesn't follow through, breaks above an internal swing high, exit the trade, and you wait for the next trade. So the daily chart remains in the downtrend for now on the euro dollar, And this is a current chart, and I am waiting for the 21 to cross below the 89. If that does happen, I will take another short, but I'm still going to keep it relatively small as that Euro trend is quite extended. All right, if the daily chart changes direction and the 21 crosses above the 89 on the daily, then I would be looking to go long. The results for those 4 trades: the first trade was 800 pips, second trade was 350, the third trade was a loser, 178 points, and then the fourth trade only gave us 58 pips profit. That's before costs. You can just add in your costs over there. So the total for that little session, that's from December last year, is 1,000 pips profit. I'm quite happy to do that over and over again every year on different currency pairs. It is a simple yet effective way to trade shorter term in the direction of the underlying, but most importantly, defined trend. If I can define the trend when I look at a chart, I know exactly what I'm looking for. That's the way to make longer term trades. If we have a look here, I've got the pound to the dollar, and I've included it. It did fire a buy signal this morning. So on the daily chart, it has crossed up. You can see it over there. Entry 1 can be taken. You can see this is a demo account with Webtrader. Taken a small long on it, and the stop is below a swing low, which is that level there. It's about a 500-point stop loss, so please work out your capital requirement for that. If the moving averages cross down in the opposite direction, that's also an exit. The 4-hour chart can now be traded if the EMAs cross down, then up again. So I need the 21 to come down through the 89, cross up again before I can enter on the 4-hourly chart. And cable does have a good outcome for the last 2 years on the system, so I'm quite happy to give it to you guys to have a look at, so long as this competition is running. The idea is to accumulate pips over time without too much stress or drawdown. If you have stress, your positions are too big, or you're just really uncomfortable with losing money, and you're going to have to get past those if you want to become a good trader. There also has to be a balance between too many trades and the resulting profit or loss. The point is, if I trade a lot, I'm going to be right and wrong a lot. When I'm right, I'm going to be making a little. When I'm wrong, I should be losing a little. And I've got to make 30 or 40 trades to make up for one 4-hour trade. So there's a time value as well in the whole idea. I don't like to trade too many times in a month. I'm just looking to make steady profits. It isn't easy to do this, but it can be learned over time and with practice. I still suggest do it with small money as you're learning. Obviously, while you guys are on this demo account, you can give it a good go. When you get to real money, take it easy and make sure that you understand the system. So just to illustrate that a little bit more, the pound-dollar daily chart, you can see that was also trending down since last year. I think it was June. And we can see that that long-term trend, just on this picture you're holding since October. If you look on your 4-hourly chart, okay, I don't have enough history here, but you know, you'd get a couple of trades, but there are weeks in between each trade. And that's why I would like to hold my trades a little bit longer, so I don't have to trade too often, get a proper stop loss, get out of the position, and then wait. And you can see here the 4-hour chart crossed up at that point. Now the trend is down, so I'm not interested in taking that long. Now the daily's changed, I have to wait for the 4-hour, and that could take another week or two. It might not cross down for another month or two. If you go and have a look at your longer time frames, like your euro dollar and even the pound US dollar, those 4-hour charts actually remained in the trend for nearly half the time. So you're looking at about 6 months just on the 4-hourly chart. And there was no way to trade a crossover in the direction of that trend, so you just had to be patient. Or you can start looking at the alternatives. And one of them would be right now this 4-hour chart has broken above a double top. If that price does come back and gives me a bullish buy signal, I can take a small trade before the averages have crossed. But I wouldn't be climbing in with a full position. So the idea is a little bit of patience, wait for the market to come to you, wait for the trades to fire, and then wait for the stop losses to signal. In other words, don't rush your trading. The idea is to accumulate pips over time, not trade 1,000 times a month. All right, thank you guys. I hope you found that informative. Please feel free to ask some questions.
Thanks, Warren. Someone saying, are we recording? Yep, we've recorded. It'll be up on Webtrader and Standard Online Share Trading later this morning. Folks, if you've got questions, drop them in the Q&A box. We certainly got some time. Bongani saying, you say, does a short mean you use CFDs? Bongani, no. So a short does mean that you're making money on the downside. But because we're trading spot FX, when you open a position, you can elect to either buy it, make money when it moves higher, or you just sell it, make money as it moves lower. So it's just the spot FX. So it's not a CFD product, just a spot FX product. Question coming through, can you explain the difference between gearing and leverage? Warren, I would say they're the same, are they not?
No, they're not. Your gearing is actually the relationship of your margin to exposure, and your account is leveraged.
Gotcha.
So the idea is that I've got a $5,000 account. I can take a $50,000 position. That means my account is leveraged 10 times.
Gotcha.
So that's the big difference.
A question coming through about the 2189 EMA. I know you use that to identify trend or direction. Do you also use the crossover of 2189 for signal entries?
Yes, that's exactly what I do, especially on the daily charts.
Cool. So it runs both ways. A question coming through around time frames. What is your preferred time frame, your ideal time frame to trade FX in?
I prefer dailies and 4 hourly. The 4 hourly was going to give me more trades, and the daily is going to make more money.
Gotcha. But what a sense. And I was chatting with Aussie Trader. I did an interview with him last week, and he's moved from index trading to FX trading. And he came with the same deal. He said that so he's trading 4 hour daily, and in fact sometimes he's even dropping out to a weekly chart. And then the question was, you're talking about trades that run for a year to 18 months. The one question was, is that still trading? To my mind, the answer is yes. Warren, you're taking it? To me, it's still trading.
As far as the taxman is concerned, it's trading because you're taking leverage.
Yeah,
there's a technical point. The other idea is it's not just holding one trade for 18 months. Next week, I'm going to share how to use that trend and multiply your position. Okay, so the first trade is a trade because you don't expect to hold it forever. So investing would be holding forever. Trading is you prepare to exit.
Gotcha.
And then it's adding to those winning. That winning must be added to, otherwise you'll never make real money.
Yeah.
So to hold one trade for 2,000 points, let's say that equals $2,000 at $1 a point. Nobody's going to retire on $2,000. But if you've got 5 trades making you $2,000.
Gotcha. Alan is asking. So I spoke over there. Alan is asking around Forex futures versus Forex spot. So Alan, what we're looking at in the Webtrader environment is the Forex spot market. That's what most folks are trading. The futures market is a JSE product, so you would trade that with an online share trading. The key difference with the futures market is just that you're looking at a future price. So it will be different to the spot price. Which is better? It's a personal preference. I can tell you that in the spot or futures market on the JSE, there's limited crosses that you can trade. It's about a half a dozen of them, and they're all based back to the rand. Whereas on Webtrader, there's over 100 different pairs that you can trade, including a lot of the major crosses. In other words, your dollar euros, your dollar sterling, as we saw here. Pritesh, you're asking about time delays, if any, on the Webtrader when performing the 4 hour, for example. Pritesh, the Webtrader is even the demo account in FX is live, and certainly if you're trading in a live account, you're trading live. So no delays, it is live. The fact that it's 4 hours, what we're saying is not that it is delayed by 4 hours, but that each candle is 4 hours of information. A daily chart would be a single day's information. An hourly chart, obviously, 60 minutes. A question around taxes, great question, and I'm going to preface this by saying I'm not a tax advisor or a tax expert. I am simply a taxpayer. The profits you make will be there included in your gross income because I suppose it's revenue in nature. Kaputsa, you're 100% right. It's included in as income, so you tax at your marginal rate. Importantly, obviously, you can subtract the costs from that income. That would be transaction fees, that would be losing trades, that would be subscription services, etc. Jacko, you're asking if FX can be traded on OST. So you can trade FX futures on OST, as I mentioned a moment ago. It's about 6 of them. But if you want the spot FX, webtrader.standardbank.com is where you go to trade spot FX and a much wider product range in terms of FX. Questions coming through. Kieran, are fees for carryover trade to next day? Kieran, I'm not sure I understand your question. If you can either send it back to me, I'll try again, or contact the folks at Webtrader.
There's a swap fee, Simon.
Okay, Warren, jump in there.
Yeah, it's a swap fee, so there's a bit of interest paid overnight.
Okay, is that?
I'm not sure exactly how Webtrader does it. There's usually like JABA +3 or something like that.
Okay, gotcha. That's for holding them. So if you're intraday, not an issue, but it's an overnight fee.
Yeah, and if you hold for 12 months, it's going to be that 9% or whatever for the year.
Yeah, gotcha.
So you divide that into your daily.
Yeah, and I mean 9% is a big number, but if you're making money trading, it's a cost of trading.
It's a really small number if you're good at it.
Yeah, I mean, it should in the essence. I mean, it's certainly there are costs there, but particularly if you're trading a leverage product, and not even if you're massively geared, but you certainly want those costs should be relatively small in the big picture. Yes, I have recorded it. Video will be up later. Some folks saying they arrived late. So absolutely, we have recorded. A question coming through, Warren, and I don't know if you pigeonhole yourself like this. Do you consider yourself, are you a swing trader? Are you a trend trader? What would you describe your trading style as? Or are you just a Warren Peacock trader?
No, I do consider myself mainly a trend trader.
Mm-hmm.
But the minute you start trading intraday, you're a swing trader. So on a 4-hourly chart, you definitely trade in daily swings. So it's a bit of a hybrid, really. On the daily chart, you trade in trend, and then as soon as you trade on that 4-hour entry, you actually trade in the daily swing. So intraday traders also.
I do like the definition. I hear what you say. If you go intraday, whatever you're doing, you're pretty much a swing trader.
It might be trend. I mean, it's 4-hourly trend.
Yeah, no, sure.
So it's still trend trading, but if you look at the definition, I don't even know if you want to define it, but a swing trader is someone who's in and out regularly.
Gotcha.
So if it was a daily chart, the 4-hour trades are in and out regularly.
Nick, I got your question. I'm going to send you my email. Drop me an email. I will reply to you with the relevant peoples. Done. There it is. You got my email. Warren, last question coming through, folks, because we're hitting up time. If you want to quickly try to sneak in another one, but question to you, Warren, is preferred time frame. You're saying 4-hour and daily. You said those are your preferred. The question is, what about 15 minutes?
Yeah, you can trade a 15-minute chart. What I find difficult really is to make money on a 15-minute chart. You have to take excessive leverage. You know, if a currency moves 30 points on a 15-minute chart, 30 points is a relatively good move.
Mm-hmm, mm-hmm.
In terms of cash, I've got to trade 3 times a day on a 15-minute chart to make up for the daily return on a 4-hour chart, if you get my meaning.
Yeah, and short answer, it is then just simply hard work.
Yeah, to me, it's pretty hard work.
Hard work.
Obviously, there are successful.
No,
they're successful day traders. You know.
Sure. Yeah, and it comes to the point. I'm a fan of lazy trading, and to me, 4 hours that's not even terribly lazy. And then the last question, 4-hour chart. So obviously, it's what about the one that fires at midnight or 4 a.m.? Are you setting your alarm clock or are you ignoring them?
It depends which currency it is. If it's like cable, pound, dollar, it's normally going to move in the morning. I start work at about between 5 and 5:30. Mm-hmm. It's not very often that I'll miss a cable or a euro-dollar move. Mm-hmm. But when you're trading like let's say Aussie dollar, Japanese yen, mm-hmm. I trade them so seldom because I'm not awake at 2 o'clock in the morning when they tend to fire.
Yeah. No, fair shot. If you're up at 5 or 2, you
definitely. Yes, I do miss. sometimes the dollar moves at 11 o'clock at night and I'm not watching. That's just tough luck, because I know that within the next week or two there will be a way to enter that trade if it is in a nice trend.
And that's an important point. You're not going to chase it. You're going to say, you know what, I missed it. Unfortunate. There will be another one that will come along.
Yeah, you got to look at this over a 10-year period, not a 10-minute period.
Yeah.
You know?
No, they're like buses. There's always another bus coming. We don't have another taxi to run you over in the South African vernacular, I suppose. Ladies and gents, we've hit our 30 minutes. We're going to park it there. My thanks to all of you for attending, and thanks for your questions. Warren, really appreciate your time today. Video will be up in a couple of hours. The system will automatically send an email. We'll include the video link in that email as well as last week's video. And then, of course, we are back next Tuesday, 19th. And then again on the 26th of May will be the final one for May. Ladies and gents, thanks very much for your time. Warren, really appreciate it. Thanks, man.
Pleasure, Simon. Cheers, guys.